being that this is actually the time frame that we would probably be using, the scalping micro volatility monitor, I will leave it up for reference, right? So on anything that's about 1 hour or smaller, perhaps 2 hours, you could go larger, but you might be being too conservative if you go larger. There might be a setting that's more appropriate for like the 4 hour, the 1 day. There's a point in time where I maybe would consider using a different one, but definitely for the 2 hour, 1 hour and below, scalping might be a good option, and for below the 1 hour, scalping is the best option. And what it does is it actually does its best to essentially contain volatility for a period of time, right? So here are some bullish periods of time where overall it does a good job. Occasionally there is a wick that creeps into the volatility zone. So it is possible for it to get breached, but a lot of times you'll notice when you have a time frame with a consistent green cloud or a consistent red cloud, it stays that way because the body of the candle does not close outside of the cloud. Only when the body of the candle closes outside of the cloud does the cloud actually change, right? So these are moments, in fact, this cloud, or this moment right here within that red cloud, that was the moment that, as you can see, the body of the candle actually closed below what was formerly a green cloud that was kind of staying flat. And so the moment that that candle had pressure that closed below the green, in this case obviously well below the green, it started its next red volatility cloud, right? And so again, these are all in the scalping time frames. We have this scalping micro setting for, again, 1 hour. Anybody who's trading smaller time frames, if they're really trying to find a great entry or they're trying to identify where volatility is likely to take it, this is a good setting for it, scalping micro. Again, my personal favorite place to use it is like the 1 hour and below, and I like to check it just to see what it looks like in maybe the 4 hour and below. Can you use it in other settings? Yes, but there are probably better ones to identify changes in trend and things of that nature. So this just gives you an idea of the volatility cloud changes, and so now you're in a green volatility cloud, and so a lot of us like to look for that orange on orange confirmation, which you can find here, but you could also use pressure lines and volatility cloud to come up with an interesting, strong, highly probable, especially versus somebody who has no tools, no resources, method of finding a decent trade, right? So if I take this here and I say I'm going to be kind of conservative, I'm going to go ahead and make my entry, the cloud, I'm just going to wait for price action to go there. This would be it. And I would be using the 2 week line, which was pretty fresh at that moment in time. This happened to be 7 in the morning. These are all 1 hour candles. So there would have been moments in time that people could have been fearful, which is why we oftentimes are proponents of low leverage, right? You're less likely to get stopped out. You can afford to have a wider stop loss zone. So if I 10x leverage this, then I stand to lose with this exact asymmetry. I stand to lose 7.9% of my capital. So I could protect that by having a smaller or lesser absolute value, or I could simply trade with less leverage. So instead of 7.9, I'm maybe looking at losing about 4% of my capital if I do a 5x leverage trade, right? So I might choose to do something like that if I were going to enter this trade in the first place. And just based off of these things, that's probably what I would do. I'd say, okay, if my thesis is based on volatility cloud changing in this small time frame overall, and a retest, a bullish retest in this case, of pressure lines, which we talked about in the video before, then this would probably be my trade. I would really have no real basis as to why this would be my take profit zone. So I would probably look for either the 3-day line at the time, right, the 3-day pressure line, or maybe I'd look for, do I think that larger time frames have what it takes to send it up to here? And if you really look at it, this is just very random, but if I really look at it, Had I entered that trade, it actually could have been a trade that lasted quite a while, right? And as far as days, this would have lasted from the 29th, give or take, of January to the 8th of February, and I'd still be in trade, and I would have never gotten knocked out. I could have literally set my stop loss here to where if I lose on a 5x leverage trade, I lose 4%, and then I could have set my take profit well in advance, way up here, to where if I win, I gain about, about half of, what would that be, 14%? So 14 times 5, right? 70, right? So I maybe would stand to gain about 70%. And this would absolutely be technically a set it and forget it trade. This one just happens to be one that would be perfect, right? We happen to get that pump today. And again, if it takes us all the way up here, you could have used this data to, in an automated fashion, set your entry, set your stop loss, set your take profit. I would never use, I can't say I would ever really recommend using just the 1 hour. This is just very much a coincidence that this happened. Because another thing that I usually, let me hit these alarms real quick. Okay, sorry about that. Okay, so as you can see, in this case, it happened to work, but we usually want to work with larger time frames. I have a lot of alarms going off because it's 6 p.m. and so the 1 days and 4 hours, 2 hours, a lot of different alarms for a lot of assets are going off. So I apologize. That's what that was. So with that being said, this is what the same data would have given on a larger time frame. So you can see the volatility clouds actually last quite a bit longer, regardless of the setting you have them on. They're a bit more consistent, and this is what it would look like to use the ultra sensitive reaction or scalping micro time frame on the 4 hour. But I just wanted to kind of give some perspective, which that 1 hour was a great example of what it looks like to utilize the volatility clouds for real trading, right? This one right here. Even if this was your only trade and you were not trying to make it a 10-day long trade, that in this case, I would say, I assure you, would purely be an accident if you successfully pulled it off. But even if you were just using it for this one trough, it's a great example of taking a position, getting into profit, and then you'd probably be in a position shortly after to collapse your stop loss and then push your stop loss into profit, right? And even if you just wrote it up with a trailing stop loss up to about there, it still would have been effective, right? You would have went in here, entered your trade, been in your stop loss zone, kind of in negative return on equity for a little bit, but then overall, this is a great example of where the trailing stop loss, if set appropriately, would have done all right, and then it would have taken you out maybe right there or somewhere in that vicinity. It's also possible that there was enough volatility in here to take you out, so it just kind of depends. But whether it's a trading stop loss or whether you just manually move it along the movement monitor and then eventually it takes you out when price action crosses back over the movement monitor, sometimes that's a great way to go about it too. Requires a little more patience, so a lot of people are they don't have that. And then other times you have to just do what you can, maybe move it here, and then go to bed. And so you don't get a chance to see what's going on until you wake up. And you're either in a position to push it into profit or do well. Some people will have take profit zones set so they can take profit in an automated fashion. You can have staggered take profits where you have 1, 2, 3. I mean, there's a lot of different things you can do depending on how you interpret the data and what your trading goals are. But I think that's a great example of the how to use it, how you can take a look at it for trading purposes. You can do the same thing on the short side. Here's a great example of one of our classic setups, which is a green trend change, right? And it happened over here too. This one just happens to be the nice pump. And it kind of shows you that the algos always have the propensity to catch the pump, especially if you use them across time frames. You can identify them a bit early in a lot of cases. So in this case, this was the hour. A lot of us, we're looking at time frames as small as the 24-minute, the 45-minute, but definitely the hour, right? So somebody could have easily said, hey, I've got orange on the 1 hour here. I'm going to enter a 5x long. And so they have a lot of different options in what they might want to do with this data, fully utilizing these same algos, right? So I always kind of talk to people about setting up their trade first and then deciding on magnification after you see how good or bad the setup is, right? Like how risky is your setup. And so what I would probably do here is look for logic that might support a lower, less intense stop loss zone, right? So this one is a great example, right? If I push this to the first orange on orange, even if I go all the way down to the green, I would say, okay, that's reasonable, 0.77%. On this time frame, on a 1 hour time frame, if I get lucky, the type of move that I'm looking for would be take it all the way up to the next pressure line, right? So I have to ask myself, like, is that possible? If I look at larger time frames at that moment in time, is it possible? And that's kind of what I would probably look for. And with that being said, I would probably do something like this, and I'd have to ask myself, from an absolute value, from a risk standpoint, am I comfortable with whatever I do losing 0.77% as an organic percentage? Yes, that's actually pretty decent. If it goes up here, that's really amazing because that's about 14, 15 units of reward per unit of risk, right? So that's pretty amazing by anyone's standards. But with that being said, I would look at that and then I'd ask myself, how much do I feel comfortable leveraging this trade? And a big part of that equation is knowing that this is going to be magnified by my leverage. How much do I feel comfortable magnifying that? So if the answer is 5, then I have to ask myself, okay, give or take, with slippage, this is probably 8%. 8% divided by 2, because we're not 10xing it, we're 5xing it. So 8% divided by 2 is 4%. So I'm basically risking probably a little over 4% when you account for slippage with 5x leverage. And am I okay with losing 4.5%, maybe even 5% if the slippage is really extreme? Yes, but it matters how much organic capital I'm looking at risking, right? Like what position size am I thinking about taking on? And that's going to be a different answer for everybody. So if somebody might say, okay, that means with $1,000, I can 5x leverage it. The exchange is going to treat me like it's a $5,000 position. So I have to just ask myself, am I okay losing this amount of money times 5, right? So again, just a great example of how you can use a volatility monitor cloud for trading purposes and or for statistical, not guaranteed, but statistical volatility purposes, right? If we follow it along, this is a great example because this is obviously the most recent data and it's one that actually worked. But if you follow it along, there's not so far been a point in time where that cloud's been breached. And that's kind of the beauty of catching a nice move on the volatility cloud. So we kind of look over here. I could have maybe done about the same thing here. I could have said, okay, I'm going to enter here. We've seen situations, plenty of situations, where the cloud gets breached by a little bit, and at the same time, it does not close below the cloud. So the cloud is doing its job, but it's not there to give you the exact answers to the test. It's there to give you statistical probability. So in this case, if somebody entered right around that orange line, give or take, then it probably still would have been just fine with a 0.55% stop loss zone, right? That's just by coincidence that they would have been good there. And if they would have entered there, they would have actually, coincidentally, also caught this ride so far all the way up to there, right? So 6% gain, that's about 30% on 5x leverage. And if it goes all the way up, even better, right? Because now it becomes 12% times 5, right? So a little over 70%, 72%. So that's really nice. That is the purpose of this particular algo. It gives you a statistical idea of where we will encounter volatility or where it might go to. So another example of orange on green, and I want to zoom in for everybody there, right? So we can all kind of just see that right around here was where it went orange on orange. If a person entered right around the line, which is nice, then again, if they believed it was going to go up, they could have probably taken their asymmetry calculator all the way up here, said, yeah, that's a good trade, I like the potential, and we would have done the same thing, right? A lot of traders, depends on who you are. Some of us will stay in a trade and go through down pressure where they endure negative equity. It's dangerous. Psychologically, it can be stressful, it can keep you up at night. I don't particularly do that, nor would I encourage that, but some people choose to do it. I would just recommend your position size be accounted for. And so what they would do, there's two ways to look at it, right? You could set your trade up there. You could easily ride the price action up here. You could move your stop up all the way along the way, and then you could capture whatever price, right? You could also set take profits along the way. So you could capture take profit 1, 2, and 3 based on different logics, maybe different algos. You could even use the 1-day pressure lines, right? Something of that nature. Let me give you a good example. We'll see if they stretch that long, but I'm thinking they would. So we will see how the 1 week and 3-day populate. Okay, so there you go. The 3-day, not so much. The 1 week, it's a great example. The 3-day may have populated there at the time, but they only last 3 days, and they just began again. So I think this was probably like 7 days ago. Today's, oh no, I take that back. Yeah, they just started again though, so that's why they didn't go back. This would have shown up in the last set of 3-day lines. But at any rate, you can kind of see like, okay, here's a point of resistance, and so if this trade went above this white line, you could probably make a good case to move your stop loss to the white line and or make that white line your take profit zone. In fact, that might have been what some people would measure from the very beginning as a take profit zone. So this gives you an idea of different use cases for the volatility cloud. This happens to be agile volatility reaction, right? So this is for short-term time frames or micro, which means everything inside of the micro time frame charts. That would be approximately 2 hour, 3 hour, 4 hour, 6 hour, 12 hour, 1 day. You could probably go larger, but that's probably the sweet spot for agile volatility reaction. Coincidentally, that's another good range for dynamic. Dynamic just has a farther look back period in what it's considering as its statistical input, right? So in other words, so I know this can get confusing for what it's worth, if one setting looks back this far and accounts for all this price action, and then it decides this is what the statistical probability of volatility is, then another one with a longer look back period, such as is the case with dynamic, goes back a bit further, and it says, I'm going to take all this into consideration. And then it builds a volatility cloud for that, right? So it has that, and then some custom configurations for average true range and things of that nature, right? Just how much can we expect this to statistically deviate from different moving averages and from statistical price action. So kind of a cool pet to have, a cool tool to utilize. And that is what allows us to a really high degree, utilize these clouds to do well. One point I want to make before I go on to the trend-seeking cloud is when you see a volatility cloud that gets disrespected quite a bit, and you see what I like to call the Nightmare on Elm Street stripes, right? The red and the green sweater from the Freddy Krueger movies. This is just a really easy visual for me, especially when you squeeze them together. It's an easy visual for me that says, be careful, in this trading environment, you are prone to encountering chop. And you may get sliced up in your trading, and it may turn into a bit of a nightmare, right, monetarily. And so that's kind of how I see those. If I start to see periods with a more sustained color, right, based on what I'm trying to do, a more sustained color, and I see like quite a bit of it, or if I find that in larger price ranges, in larger time frames, then I might choose to utilize the cloud, right? To actually count on the cloud for my own statistical probability purposes, right? So I might say, I don't know if I trust the 1 hour. Let's see what the 4 hour looks like. So now, again, this is one of my personal favorite settings, the dynamic volatility setting, dynamic trend reaction. This is for midterm, which is, again, anywhere from probably the 2 hour on to the multi-day time frame. And it could actually work for, larger time frames. But when it comes to larger time frames, I go into trend seeking, and I'll show you that as well. So for now, I'm going to manipulate time frames, still on the dynamic setting. And I just want to show that the larger time frames give you an idea of what's going on with regards to the trend we're in, the price action, is it ranging? This is kind of really still Freddy Krueger stripes or Nightmare on Elm Street stripes on the 1 day, right? Like what we've been experiencing just for this past little while, this past month or so, is still striped. So you have to be honest with yourself when you see that. Before, it was a little longer of a period, and we could see the volatility monitor doing an uphill climb, which is always a sign of bullishness as well. So when we see the volatility monitor doing an upward climb with orange on orange, it's a great opportunity to consider a long, right? Look at other time frames, but what a beautiful entry, right? And relatively obvious, right, from the very beginning. And who knows where we would go? Nobody could have really known at the time, but I believe we did actually in DIIO, especially in the MSAs and the Telegram group, right around here, I think it was October 22nd specifically, we had found that many time frames, including the 1 day, including the 3 day, including even the 1 week and larger time frames, were orange on orange. And so this was just a great opportunity on the 1 day time frame to consider a long, right? To consider a purchase in the case of a spot position. And that's kind of one of the points that I like to make to people is the algorithms actually not only work for people who are trading based on derivatives, they also actually do a great job working for people who are considering investing in the larger markets, right? And we could not have known it was going to go up there, but you can see that in that case, risking 4% on an entry in what appeared to be a highly probable, statistically speaking, entry with orange on orange over a rising green volatility cloud, that it might have at that moment in time been worth it to risk organically 4 or 5% of your position, right? Because I know some people that are putting 10,000, 50,000, just very large amounts of money into the market without any analysis, without any research. And if someone's going to do that, then to me, it just stands to reason that they might consider a bit of statistical probability, wait for price action to touch that orange movement monitor, whether it's that day or whether it's the second day, which is even a better entry from the standpoint of using the volatility cloud, right? If we really want to kind of see what those entries looked like, the first day, you didn't really have a complete close, but the first day you had an orange bar close. The second day, you at least had the foresight to see that an orange movement monitor was pending, right? And so toward the end of the day especially, you could see that close. And so anywhere in here, you had a nice opportunity. I'm not going to count that risk reward because we couldn't possibly have known it would go that high. But I will kind of look at, what was it between the volatility cloud and the price action, or even the movement monitor and the price action. It was within 3%, which is great for a 1 day position, right? The 1 day use case. If every day you just moved your entry, as long as conditions were conducive, you just moved your entry a little closer and followed that movement monitor up, which takes a lot of patience, right? Because the person that missed out here would be frustrated that now it's at 29.9 and it's still not retraced, and they'd be frustrated here as well. And then finally they'd get their entry. And what's beautiful about that entry is it was literally about as tight as you could get. It actually tapped below the volatility monitor on this one, but at the same time, you can see it was above the movement monitor. And so this one, statistically speaking, created the best use case for asymmetry. right? To the tune of, even on a spot investment, somebody who got in that day was somewhere in the neighborhood of 1.18% at risk. And you had the ability to, in the case of the 1 day time frame, use the multi-day, multi-week. So let's look at this, because to be honest, this is the setting that I think I would have used, and it probably would be well, as you can see it right here, that the volatility cloud did have a break, right? It opened in the cloud and then it pushed up, right? That was obviously a green candle. It's orange because of the algos, but that was a green candle. And so it essentially opened right here, and at one point in time it got pretty close to the movement monitor, definitely within 1%, right? If I just transition this even one step over, you can see right there it was well within that space. In fact, it was less than 0.5% from the movement monitor. And the volatility cloud surprisingly was green and rising on not just the trend-seeking setting, but also on the dynamic setting. So this was an opportunity from a spot perspective to get into the tune of a 1% risk, like where you'd actually have some logic behind setting a stop loss at 1%. So if somebody put $10,000 into Bitcoin, this would have been a good place to try to get a great entry and risk $100 if you're wrong, if price action just plummets, right? Because orange on green was wrong somehow. But it's always a great entry to get in, or I won't say always, it can often be a great entry to get in inside of a green volatility cloud, right? If you can just catch that fringe wick in otherwise bullish trend with all the data, let's just say in situations where all the data is bullish, it can definitely help you out a lot. So something to consider. And then as you can see in this case, the movement monitor just kind of stayed orange all the way, which is another algo we will go into. There was one moment of green, but I think overall the volatility cloud did a good job of kind of showing us where the volatility expectations could or should be, right? Where they should statistically be. And I do want to point out, I think everyone can notice this, but I do want to point out, like, here is a moment where it did not close, but in a moment of down pressure, it went into the cloud. So is that a great entry if somebody catches that? Oftentimes, yes, it is. Is it scary when the 1 day is deep blue in our world? Because deep blue for us means bearish confluence. Yes, it is, right? That usually means we have 85% of our KPIs indicating bearish pressure. But you'll often hear that I look at the bars as emotion and pressure, right? And I look at the lines as actual perspective on trend, volume, direction of price action with less emotion tied to them, right? So that's why I look at especially orange lines or deep blue lines that way. They take away a bit of price action emotion that would otherwise be present, as do the volatility clouds. Volatility clouds also kind of help me remove the emotion. I don't have to worry about all this noise if I just simply do what I often do, which is come over here, hide it, and I just simply look at this. If all I had was this, it would probably be a lot more peaceful. Now I need the candles because we trade based off of real price action, and we want to be able to study that, find opportunities, mitigate risk based off of real candles. But if all I had was this line and this cloud, I would already be in a pretty good place. So kind of keep that in mind. It's a good way to reduce the noise, remove the emotion, and then you kind of look for the places where the price action does not fully respect the cloud. And the more you see that, the more cautious you want to be in your plays to maybe allow for your stop loss zone to go a little bit into the cloud, right? If you see blatant disrespect everywhere, like on some of these altcoins, right, you might see disrespect of these volatility clouds in a lot of places, and maybe the body does hold up, right, the body of the candle does hold up, but you see wicks just like these everywhere, then maybe, just maybe, you do not want to use that cloud to count on to protect you, right, for your stop loss or otherwise. Maybe you need to use a larger time frame or a different cloud. So those are some things to consider. So this kind of gives you some perspective on the 1 day, and this just happens to be the trend seeking, which is created more for the multi-day time frames, which again, this is a great example, or the multi-week time frames. So you can see, some areas where down pressure was pretty significant. We see Freddy Krueger stripes still forming, even as we speak on some of these. We could easily just be ranging. This may be a moment of up pressure in the grand scheme of the past 60 days. It's very, very easy to look at this and say, okay, this literally could just be that right there with a little bit of that right there, and we're going to range for a little while. Like, we really don't know that this is like the start to the bull run. But what's really interesting, of course, is people often imagine that any time that this happens, they assume we're just on our way to a $500,000 valuation. At least when it comes to Bitcoin, that always seems to be the trend. So I think this just allows us to get perspective. And so as I look at even the 1 day time frame, even though we feel a bit bullish right now, I get to look at it and I get to say, hey man, I'm even seeing the Nightmare on Elm Street configuration with the clouds, even on the 1 day, even on trend seeking. So until we really break out of that, until we break an all-time high, I'm not really in this macro bull market perspective. I'm more in a trader mentality. And if I was going to pick a point where I should have been in a macro bull market perspective anyway, it would have been, way back here, and we would have looked at something like the 1 week just to kind of get an idea of what it looked like, right? And so got a little bit of perspective of, what it looked like when the bear market, for all intents and purposes, kind of ended right here. And it's kind of neat that the volatility cloud led the way, right? It led the way before the movement monitor even turned green, which is fine. It's the weekly. And as you can see, this was a great place to consider entry too, because it's not normal for us to have a 1 week volatility, a 1 week movement monitor go orange. We hadn't seen that since the time it went orange here. And we can see the follow-on price action, right? Then we saw it here, and we saw the follow-on price action. And again, each of these candles are weeks. And then it went kind of down, went into this cloud again, and then we saw it again here, and we're still riding this one, right? We only had one moment of green. And so a lot of people, I think, when we look forward into the future and then we kind of reflect, we'll either, I would say that the market started to turn here, or they'll say that it started to turn here. Just depends on your perspective. The actual inflection point from the bottom probably was right around January of 2023. We had mentioned that in MSAs as well in our private chat section. So we've got some cool charts on that were really based on not a whole lot more than logarithmic price action. So with that being said, let's take a look at how it looked over here, right? The initial bull market of, what was this year? 2020, right? When it started in 2020. This simple, right? Now it's very, very easy to look in hindsight that it was this simple. It was kind of some orange on orange there. We went away from orange on orange. We had some green, but it went orange on orange here. Second opportunity for entry, and then it went orange on orange here. The whole time, there was never a disturbance from this green volatility cloud. And once it started to flatten out, we had to start kind of questioning, is a top close, right? Because the next thing is usually for price action to at some point come back down, test the cloud. If it doesn't, if it doesn't bounce off the cloud, then to go through the cloud and start a new red cloud. And there's always a red cloud after a green cloud, and there will always be, even if we're doing this same thing 6 years from now and I'm talking to you about Bitcoin in the 400s, it doesn't matter. No matter what, we may be in the 300s and I would still be saying the same thing. There will be red clouds and green clouds as long as there's volatility, which is why we call them volatility clouds. So that's kind of what these looked like. We can kind of spot another orange on orange configuration on the weekly here, and we got sent up, even though we did have emotion in the form of deep blue there. We had perspective, macro perspective, in the form of volatility expectations with our cloud, right? Then again, we went into an environment of threat with the bearish red cloud, just as we did here. Both of them were periods of significant down pressure. And again, this is when the 1 week volatility cloud changed. So just kind of gives you some perspective on just how significant the change in a 1 week cloud can actually be, as you can see. And then we went up, small bit of red there, still in green, still operating in green, which is pretty cool. And we'll kind of have to see how it goes from there, because as of right now, I was going to look and see where we were at. We were flattening out, which can be a little dangerous, a little bit of indecisiveness. We have to test it. We somewhat did test it here, give or take. And then now it looks like we're starting to see the volatility cloud continue upward. Now, it hasn't closed that way, but it's kind of nice, because that's saying that per each weekly candle, the volatility expectations for the low are actually rising, which is somewhat indicative of trend, right? It means we're kind of trending for our lows to climb and go higher, right? So if our next low at some point is 41,000 instead of what it's at right now, about 38,000 for the weekly, I think that's great. Again, for volatility specifically. If I take you to show you what the volatility cloud might look like on the 2 week, again, even from the perspective of like this could be a wick, this just kind of goes to show you that right here, it gives you a perspective of, hey, right around 37,000 is where it's at. If I go to look at something larger, like what is possible, not probable, but possible from a volatility perspective, what could a wick take us to in a moment of extreme down pressure with crazy bearish news, right? Usually it's some sort of crazy bearish news. This could stay an orange candle, it could close an orange candle, and it's just saying within any given, in this case, 21 days from today, price action could wick us down to there. Just like it wicked us up to there, just like it wicked us down to there, volatility is pretty high on the 1 week. So it could literally take us in a couple different directions. However, pressure from the breakout bars does show us that right now we are looking statistically bullish, right? We have a lot of things to kind of be bullish about, right? We have the movement monitor, which is orange. We have the monthly cloud, which is orange. We have, the orange breakout bar, which is orange. And then we have the monthly volatility cloud, which is green and rising with a pretty nice slope, pretty nice upward slope. So again, this happens to be the multi-day, multi-week setting. And so I kind of want to share, what this looks like. Gives you a little bit of perspective in that regard, right? Multi-day, multi-week setting. Okay, so I think that covers a lot of it. You can actually see some places where the volatility cloud was overall on a monthly time frame respected, and then you can also see where it had the clear break and it actually moved out of it. So something to consider. Blue on blue kind of looks like this, right, on the monthly. And this price action is pretty significant. We had some pretty good moves down into the 15,000s. I think that's about it from a volatility cloud perspective. Again, we do training on the clouds. We do training on setups. They're in different videos. So I'm not going to go too deep into that since I've already kind of covered these things. I'll maybe do one more setting. I will just kind of take a closer look at dynamic, and I'll do it on the 3-day just to kind of show that even on a 3-day perspective, the dynamic setting is pretty powerful. So for what it's worth, you can see it's imperfect. It's based on statistics, not certainty. There's kind of some parts where it opened below the cloud, but ultimately it rose so high that it pulled the cloud up, and the cloud closed right around that, right? It opened right here. That's how that 3-day candle opened, and then it pulled the price action so high that it curved like that. And meanwhile, we had the orange breakout bars to give us insight, and we had the orange movement monitors to give us insight. All right, so that is a lot of training on Volatility Monitor. And so I wanted to make sure I covered Volatility Monitor very thoroughly so you have an idea of how you can use it for volatility expectations based on the time frame you're looking at. I wanted people to see and have an idea of what it looks like on larger time frames so they can kind of get an idea of what that looks like as well. Here is a great example of just today what someone could have used it for based on the 24-minute time frame on a day when it was kind of pumping. This is the dynamic trend reaction setting, but as I mentioned, we would probably realistically, real world, use ultra sensitive reaction for our scalping purposes, and this actually would have given us a bit more of a conservative volatility cloud. So not necessarily something that you'd want to use for entries because you may not get that opportunity too often. So you may find a different way to find entries, or you could. I mean, you could if you happen to be around and you walk up to this particular setup and you like it and it looks good on different time frames. But otherwise, you may not use it for entries. You may just kind of use it to get some perspective on, is this thing rising? Is it continuing to rise? Is it being respected? Can I use it as a stop loss zone as my price goes up, right? Can I literally use this line, if my price is here, can I just keep raising it? Now my price is here, my trade's doing really well, it keeps going, the line keeps going, I'm gonna go here. If you look, my stop would be right here. So technically, you might ask, well, would that bar stop me out? But the answer is no. If I had it right below the volatility cloud, I'd have a pretty tight stop at that particular juncture, but it would still be serving its purpose. It would still be climbing. It would come here. It would serve as a great stop. Price would go all the way up here, come back down. My volatility cloud would have served as a great stop loss. It would go up here, come back down. Never at any point in time in this recent run, has this volatility cloud been breached with this one exception. And that's only if you were using a stop that was right up against it, right? So that's a nice track record, and that's the kind of track record that you want to have if you're going to maybe consider using the volatility cloud for anything serious on any given time frame. Look for a time frame that has some respect like that, or look for an environment that has some respect. If I didn't have that and all I had was this, I'd be a lot more cautious of using this time frame for a volatility cloud. And there might be some exceptions when time frames and confluence and everything line up. This is probably a pretty good example. Where you could catch an orange on orange and have a nice wide stop backed up and supported by a green pressure line. But at the same time, you have to be cautious because the reality is you have a lot of evidence that says you're kind of looking at Nightmare on Elm Street type price action, right? Which just means you can get sliced up with volatility. Here's another one where you could go short with blue on blue under red. And that's kind of another example. If it falls through and you have really nice blue bars with blue breakout bars and blue movement monitor, you could maybe use this for, it doesn't have to be high leverage, a low leverage short with this as your stop loss. And by the time it gets here, your stop loss would be way down here. So even though you don't capture profits at this very bottom, supposing you didn't, you would literally get stopped out way down here, and overall it would be a pretty nice trade, right, from there to there. So that's volatility cloud. I think I've covered just about everything for it. Breakout bars is a great one. Let me make sure I hit volatility cloud. I think I covered everything. Yeah, there's no reason to adjust any other settings on volatility cloud. I've already pre-built that for you to form the clouds the way that they are.